What's going on, everyone? Sebastian here from Crypto News, bringing you the best crypto content on a daily basis. Today, we're going to walk through exactly what impermanent loss is and how you can protect all of your cryptocurrency investments and maximize your gains when you're investing as a liquidity provider. Odds are, if you've been in the cryptocurrency markets for any amount of time, you've probably heard of the fascinating world of yield farming. Yield farming brings really high APR yields to its users for providing liquidity as an incentive to keep liquidity and trading volume on that particular decentralized exchange. And what better way to incentivize liquidity providers than providing some decent, juicy, high APR yields? Well, the good news is, yes, it's a profitable venture, but you also need to consider the potential downside on the profits you can potentially make if you didn't deposit liquidity and you just held your tokens outright. That difference in price is what people refer to as impermanent loss. So by the end of this video, you should be able to determine if providing liquidity is a profitable venture for you. You'll also be able to audit if you've potentially suffered from impermanent loss, and now you can take appropriate action to see where you might need to plug some holes, or even potentially, if it has been really profitable for you, add more to your deposit. Now remember folks, this video is not investment advice, so please do your own research anytime you invest in any sort of digital asset. This video is strictly for educational purposes only. There are also a ton of resources that I'll include in the description below to help you calculate impermanent loss. And if this is your first time watching one of my videos, drop me a comment below. I would love to see who you are and what your thoughts on impermanent loss are. Please share your thoughts on impermanent loss in the comments below. The advent of decentralized finance, also known as DeFi, has opened up a world of possibilities for cryptocurrency investors to earn interest on their holdings. As a result, DeFi protocols have witnessed a ton of volume and liquidity in the recent past. These liquidity protocols enable essentially anyone with funds to become a market maker and earn trading fees. Democratizing market making has enabled a lot of frictionless economic activity in the cryptocurrency space. By decentralizing traditional financial services, anyone can now lend funds to DeFi applications. However, while high interest rates are offered as a potential upside, liquidity pools offer a sometimes unknown downside risk known as impermanent loss. In this guide, I'll explain exactly what impermanent loss is, provide an easy to follow example, and outline the steps investors can implement to mitigate the risks. So what is impermanent loss? Impermanent loss happens when you provide liquidity to a liquidity pool and the price of your deposited assets changes compared to when you first deposited them. The bigger this change is, the more you are exposed to impermanent loss. In this case, the loss means less dollar value at the same time of withdrawal than at the time of deposit. Pools that contain assets that remain in a relatively small price range will be less exposed to impermanent loss. Stablecoins or different wrapped versions of a coin, for example, will stay in a relatively contained price range. In this case, there's a smaller risk of impermanent loss for liquidity providers. You may be also asking why liquidity providers still provide liquidity if they're exposed to potential losses. Well, impermanent loss can still be counteracted by trading fees. In fact, even pools on Uniswap that are quite exposed to impermanent loss can be profitable thanks to the trading fees. For example, Uniswap charges 0.3% on every trade. That goes directly to liquidity providers. If there's a lot of trading volume happening in a given pool, it can be profitable to provide liquidity even if the pool is heavily exposed to impermanent loss. This, however, depends on the protocol, the specific pool, the deposited assets, and even wider market conditions. So how does impermanent loss occur? To understand how impermanent loss occurs, we first need to understand who automated market makers are, how pricing works, and the role arbiters play. An automated market maker is like an order book exchange, but instead of counterparties, traders interact with a smart contract that makes the market for them. These market makers are disconnected from external exchanges. Therefore, the price of an asset is determined by a formula. However, when the price of a token changes, automated market makers adjust its price with the help of arbiters. They continue to buy an underpriced asset or sell an overpriced asset until prices offered by the automated market maker match external markets. But how do automated market makers create the market if no counterparties are involved? This is where liquidity providers play an important role, as they provide liquidity to the pool. Anyone can provide liquidity to an automated market maker by depositing their funds to a pool. For example, Uniswap allows users to become liquidity providers by depositing 2 assets equivalent in amount. Using an applicable example, let's walk through how impermanent loss can occur. Assume a trader deposits 1 ETH and 100 DAI in a liquidity pool. In this particular automated market maker, the deposited tokens pair. Assume a trader deposits 1 ETH and 100 DAI in a liquidity pool. In this particular automated market maker, the deposited token pair needs to be of equivalent value. This also means that the dollar value of Alice's deposit is $200 at the time of deposit. In addition, there's a total of 10 ETH and 1000 DAI in the pool, funded by users of other liquidity providers. This means that the trader has a 10% share of the pool and the total liquidity is 10,000. Now let's say the price of ETH increases to 400 DAI. While this is happening, arbitrage traders will add DAI to the pool and remove ETH from it until the ratio reflects the current price. Remember, automated market makers don't have order books. What determines the price of the assets in the pool is the ratio between them in the pool. While liquidity remains constant in this pool, 10,000, the ratio of the assets in it changes. If ETH is now 400 DAI, the ratio between how much ETH and how much DAI is in the pool has changed. There is now 5 ETH and 2000 DAI in the pool, thanks to the work of arbitrage traders. Then, the trader decides to withdraw her funds. As we know from earlier, she is entitled to a 10% share of the pool, meaning that she can now withdraw 0.5 ETH and 200 DAI, totaling 400. This also means that she made some profits since her deposit of tokens was worth $200. However, the case would be different if she held her 1 ETH and 100 DAI. The combined dollar value of these holdings would be 500 USD now. Therefore, she would have made more profit by hodling rather than depositing into the liquidity pool. This is what we call impermanent loss. In this case, the loss wasn't that substantial, as the initial deposit was a relatively small amount. However, keep in mind that impermanent loss can lead to big losses, including a significant portion of the initial deposit. While this example didn't include the trading fees, it is worth noting that the trader would have earned profit from these fees by providing liquidity. In some cases, the fees earned would negate the losses and make providing liquidity profitable nevertheless. Even so, it's crucial to understand impermanent loss before providing liquidity to a DeFi protocol. So how to avoid impermanent loss as a liquidity provider? In some cases of liquidity mining, if the market is volatile, an impermanent loss is inevitable since prices are bound to fluctuate. However, you can take some steps to make sure you avoid impermanent loss, or at least don't suffer a heavier blow when prices move. A good option would be to try using stablecoins as a liquidity provider. If you want to avoid impermanent losses altogether, make 2 stablecoins liquid. For example, if you provide liquidity to USDT and USDC, there will be no risk of impermanent loss since stablecoin prices are meant to be, well, stable. However, the major downside to this approach is that you won't benefit from any rise in the market. If you're providing liquidity in a bull market, there's no point in holding stablecoins because you won't get any returns on them. However, if it's in a bear market, try to provide liquidity to stablecoins and earn trading fees. This way, you'll be profiting through trading fees without losing any money. You'll want to look out for the trading fees. Traders using the pool are required to pay trading fees. The automated market maker gives a share of these fees to the liquidity providers. Sometimes these fees are enough to offset the impermanent loss you've experienced during liquidity provision. The impermanent loss decreases with an increase in the number of fees collected. Next, try investing in low volatility pairs. Some cryptocurrency pairs are more volatile than others, so providing liquidity to them can increase your risk of impermanent loss. For instance, if you intend to provide liquidity to a particular crypto pair and studying the market, you believe one of them will outperform the other soon don't provide the liquidity. However, if you think both currencies will rise or fall relative to each other in terms of price, you're good to go, since it won't make much of a difference. The bottom line is to stay wary of volatile currencies by monitoring their current and future performance. You can also wait for the exchange rate to return to normal. When you provide liquidity to a crypto pair, their rates will naturally change in the market. However, the more the prices deviate from those at which you made your deposit, the higher your permanent loss will be. Therefore, you can wait for the crypto prices to return to their initial rates and not withdraw your currency until then. However, this isn't as simple as it may sound, because the cryptocurrency market is quite volatile. Impermanent loss is one of the fundamental concepts that anyone who wants to provide liquidity to automated market makers should understand. If the price of the deposited assets changes since the deposit, the liquidity provider may be exposed to impermanent loss. Well, thank you so much for watching. Now you should have the appropriate information to make profitable investment decisions when you're looking at providing liquidity to any sort of automated market maker. And now you'll be able to see if it is a profitable venture for yourself. On the flip side, if you're already providing liquidity, you can now also see if the liquidity you've provided has been profitable for you. If it has, good job to you. Keep up the great work. And also please share some of the thoughts in the comments below on how you've managed to stay profitable during the volatile markets. Or if you've suffered from losses on an impermanent loss basis, then also share your experience in the comments below, so that way others can see and learn all the best ways to navigate providing liquidity and how to look at impermanent loss from that perspective. Well, thank you so much for watching. If you found this video resourceful, please smash that like button. It really does help support this channel. As always, I'll see you all on tomorrow's video.